We're Compound Everything, and we like to discuss markets and investing.
Mhm.
And today we are talking about Warren Buffett's worst investment, which he has self-proclaimed as his worst investment. And before we get into it, if you can like and subscribe our channel, that would be super helpful.
Mhm. So his worst investment, what was it?
Dexter Shoes.
Dexter Shoes.
Right.
And so I think he said that in a 2014 letter.
He mentioned that it was his worst investment, but he also talked about the horrific investment in 2007 or 8, around there as well,
Yeah.
in the shareholders letter. So Warren Buffett has made a few mistakes.
He said he's made a few
He's made a
mistakes.
few mistakes, and what brought us to talk about this is that everyone talks about Kraft Heinz, right?
Mhm.
And that's often, and I've even seen it said, Kraft Heinz, Buffett's worst mistake.
Mm-hmm.
But we decided to talk about Dexter because it's a far less known mistake.
Right.
But he has called it his most gruesome mistake.
Yeah.
So
At least at the time that he said that.
right.
So he says he made 3 errors in his investment with Dexter Shoes. And this is from I can't remember what letter it was, maybe a 2002 letter or something like that. The first one he says is buying it in the first place.
Mhm.
The second one,
Which I mean is obvious for everybody.
fair enough, yeah. In terms of a retrospect, that becomes obvious.
Right.
Second thing was paying for it with stock.
Mm-hmm.
The third thing was procrastinating when
Mm.
changes in the business operations were obvious.
Yes.
So like they needed changes in their business, and it was kind of dragged his heels.
Right.
And so let's talk a little bit about Dexter Shoes.
Yeah.
So if you go back and read some of his prior shareholder letters and whatnot, he had made some shoe acquisitions in 1991 and in 1992 that actually turned out really well. So
Yeah.
he bought 2 companies, one called H.H. Brown, which made work boots and shoes and things like that, and then another one called, I think it was called Lowell's
Okay.
or something like that. And they made women's shoes and shoes for nurses and things like that. And that led him, I think, and Charlie to really get engaged in the shoe business.
That shows us as investors how quickly it is for even the best to get caught up in psychological biases.
Mm-hmm.
Because that would have been recency bias. They were
For
getting
sure.
caught up in recency bias because the fish sees something moving, grabs onto the lure. It's like the
Mhm.
last thing I grabbed on that was moving was good.
Right.
Therefore, this is moving. It must be good.
must
I'm
be
going to
good.
grab it. And Buffett says they had made good shoe purchases, so they continued down the shoe industry.
And the funny thing is, even at the time of the purchase around 1993, he said he kind of identified cracks that were starting to begin in the industry.
Right.
So he had said that there was already maybe some offshoring going on in regards to shoe manufacture and whatnot, but it appeared that Dexter Shoes was not affected by it. He called it a terrific business that needed no fixing,
Right.
and with great managers in place. And so the irony of the whole thing is there were already cracks starting in that industry as a whole.
So he had identified these cracks as a whole in the industry, but
Although he didn't observe them as cracks at the time, I would say.
right.
I think he thought that the business was more resilient than that and could continue
Right.
to buck the trend because it had.
So there is actually a quote by Buffett where he says they had an advantage and they lost it.
Okay.
So that comes from one of the shareholders' letters, and it says, "What I assessed as a durable competitive advantage vanished within a few years."
Yeah.
So he acknowledges they had, or he thought they had one.
Yeah.
Obviously, it wasn't durable,
Right.
and it vanished within a few years.
Yeah. So at the time, going back to his 3 identifiable mistakes that he made when he bought Dexter Shoes, the first one, buying it in the first place. You know,
Right.
doing a post-mortem on that, how can you, in a sense, avoid
Right.
that? How could he have avoided that?
Right.
I'm not sure there was a way other than maybe not going into an industry potentially as a whole that was looking
Right.
like it may have been experiencing problems. But again, as an investor, he had assumed that the current trend was going to continue, and that is that they would continue to make outsized returns.
This is one of the areas I found interesting when he said, there were cracks, but at the time it was a good business,
Mm-hmm.
right? What was interesting to me is how much he mentioned the management was terrific.
Yeah.
And we always say it's a disadvantage not being able to talk to management.
Yes.
But in some ways, there are disadvantages in talking to management because he obviously liked the guy
Mm-hmm.
or girl. I think it was a man.
Mm-hmm.
And,
Or
they probably had some sort of relationship,
Mhm.
friendship that was positive.
Yeah.
And so that already gives you a bias into what you're hearing from someone.
Yeah.
Whereas if you don't know the people, you can be a little more harsh on them. You can, judge them in a way that you wouldn't be able to judge them if you had a relationship. And there is someone out there, and I can't remember who it is, but one of the big investors who says talking to management isn't really that great because they lie.
Fair enough. They're salesmen.
Or they don't know. They themselves they love their business.
Sure.
So they have a clouded view.
Yeah.
So
they're salesmen.
Right. I just got the impression that Buffett, he really liked the manager, and because of that, he couldn't see the cracks.
And that's fair.
And he just seems like a nice guy that way, because that's the same reason why he let Berkshire Hathaway textile company go on forever. He just did not want to lay off the people.
Right.
So he's a people person.
Right. And he had mentioned that in basically winding down the operations of Dexter Shoes, that there was, between, I can't remember, it was 12 or 1,600 people that were employed by Dexter Shoes who were essentially losing their jobs.
Right.
And he felt bad for that, and it makes sense.
And in a sense, that clouds your judgment. It makes you a kind person, but it can cloud your judgment for an investment opportunity.
From a strictly financial standpoint, Berkshire's projections actually for 1994 were that for the following year, their footwear operations would have sales of about $550 million and pre-tax income of about $85 million. So they thought that the earnings were going to continue to be robust. Right. But again, we all know what happened. Offshoring of manufacture ended up killing the business. You cannot compete as a business, I think he said this, where their labor charges are, 1/10 of yours. You just can't do it.
Yeah. One thing that is interesting is that someone actually asked him about Nike and Reebok at a shareholders meeting. I think it was in 1994.
Yeah.
And I think one of the things that may have led to his mistake with Dexter is that he way underestimated the competition.
Yeah, of Nike.
I'm not quite sure why, because if you actually read, at that time, Phil Knight was the CEO still of Nike, obviously.
Yeah.
And if you actually read the shareholders letter, the Nike shareholders letter, written by Phil Knight at that time, he actually says, our stock's getting beat up, but our company did really well.
Yeah.
And so Phil Knight's there writing this letter, and you could look at the financials and see, wow, Nike's bringing in a lot of money. They're actually doing okay, they're getting unduly punished for some reason, whatever was happening in shareholders' minds at that time. And it almost seems, again, that Buffett, I don't know if he over-trusted the management, but for some reason, he just missed the competition of new shoe companies coming in.
Yeah. So, again, that's one of the things he missed. Maybe just buying it in the first place.
Or putting too much faith in a moat.
Yeah.
Right? Like when you identify, and maybe these shoe companies did have at a time.
I think they did.
Right? A durable competitive advantage. When you identify that, you have to keep that.
Mm-hmm.
You're always fighting for that. You're always keeping it. And they obviously, Buffett says they lost that in a few years. So clearly, both the management of Dexter Shoes and Berkshire Hathaway underestimated that which was the competition.
Yeah.
And I think it's Mohnish Pabrai who says one business can take your business out.
Yeah, and I'm not sure if that's what happened with Dexter, but obviously they lost.
They lost. Yeah.
So his second mistake, he said, is paying for it with stock.
I think that was the biggest mistake.
I think that's the thing that he regrets most, because in doing the research for this video, that's the thing that I saw that came across the most glaringly.
Yeah. Well, here's another quote by him, which touches on that exactly. And he says, as a financial disaster, this one, speaking of Dexter, deserves a spot in the Guinness Book of World Records, and that's from 2014. And then he goes on to say it was gruesome. I think those are his words.
Yeah.
Because he used Berkshire stock.
He used Berkshire stock.
So you have the numbers for all of that.
All right, so here's the numbers. He used 25,203 Berkshire shares, or at that point it was 1.6% of the business, in order to buy.
So he used 1.6% of Berkshire Hathaway stock.
The negotiated purchase price at that time was $433 million.
Yeah.
So he decided, rather than to part with the money, he'd part with the shares. And so...
And that is crazy, because that is how much of a competitive advantage he thought Dexter had. Because he knew Berkshire inside and out. That was the company that he was running, right? So he knew how profitable it was going to be. He knew the businesses in it. And he thought that Dexter Shoes had such an advantage and was such a great company that he was willing to give 1.6% of a wonderful company. He knew it was a wonderful company to get Dexter Shoes. Yeah. So that was a huge oversight that he had.
And a vote of confidence to what he thought the company was and the management could do.
Yeah.
So let's turn that into today's dollars.
Yeah.
So at a current price of, as of today, which is October 31st, 2022, the share price as of today is $447,012.25.
Per share of Berkshire.
Per share of Berkshire. So if you take those numbers, multiply them together, that gives you a purchase price for Dexter shoes of $11,266,049,736.75.
That's bad.
So basically, he spent $11.2 billion on Dexter shoes
Right.
in today's dollars.
Yeah.
That's big.
That's big.
So whereas if he had just parted with the
Money.
cash, he would have lost $433 million, but that's it.
Right.
The rest of Berkshire would have been able to be reinvested and generate significant returns for
And
shareholders.
he says that. He says what made it, he said it was a bad investment.
Mhm.
He said what made it a horrific investment, or what made it the investment that should go in the Guinness Book of World Records for worst investment, was that he used Berkshire stock in order to purchase it. And he acknowledges that is what made it so grand.
He sold a fantastic business to buy a terrible one.
Yeah, he literally threw good money at bad money, or cut his winners to buy a loser.
Yeah.
All the things that everyone tells us not to do, he
ended up doing it. And so if the best investor in the world can do that, you and I can do it too.
Right, it's actually encouraging.
It is encouraging.
Yeah, and one of the takeaways that I took from that is that, you know, we're all going to make mistakes. For goodness sakes, if Buffett makes mistakes, we're going to make more mistakes.
Oh, for sure.
Right, because I always like to say he's the only person that Graham gave an A+ to.
Right, so he's smarter than us. He's more experienced than us.
Right. So if he makes mistakes, we're going to make more.
Yeah.
The question is, do the investment choices you make that are good, that are not mistakes, are they good enough to outweigh your bad mistakes? And that is the important part of an investor.
Yeah.
Because he made mistakes, but his good investments were extremely profitable.
Oh yeah, no question. So they've more than compensated for his losses. And again, he acknowledges he's made others.
Yeah. So you said, number one, the first part of the mistake Buffett says is that he bought it in the first place.
Yep.
Which is just a funny story. Number two, what made it such a bad investment, Buffett himself says, is because he used Berkshire stock in order to purchase Dexter. And what was the third reason that made it? The
third one is that he procrastinated when it was obvious that changes were required in the business.
And these are all points that Buffett himself has said.
He said those those were his 3 talking points in the mistakes he made.
So number three again?
So number three again was that he procrastinated when it became obvious that changes were required in the business.
Right. So as investors, what can we take away from that point?
The third point? So I think the thing you can take away from the third point is if you see cracks starting to show in your business, really evaluate your thesis again. And of course, it's easier to dissect these things in retrospect.
Of course, hindsight is always 20/20.
But when you start to see numbers start to reflect the story, let's say. So in this case, the story is that offshoring of shoe manufacturing is way more economical than keeping it in the United States. That was the thesis, and that would ultimately prove true.
So there were cracks in the business, and there were other shoe companies coming up. He never mentions this, right? Even when asked about Nike in 1994, he never comes out and says, "Oh, they were a problem."
Right, a competitor.
Right,
yeah.
but there were definitely shoe brands coming up that were making a huge headway within the business brand.
Yeah.
And he didn't see it coming.
Right.
Yeah.
So I guess the things, going back to your question, what can you do to prevent these mistakes is, one, know your business that you own and the industry it's in. So hopefully you can identify when there's significant competitors coming in and maybe watering down the business. Secondly, pay close attention to the numbers.
Right.
And so at that point, when it looks like it's starting to impact the numbers, when the story's starting to impact the numbers, it may be time to sell. And then I suppose the third takeaway we could take away from this is don't sell winners in order to buy losers.
Right.
We're not going to necessarily part with our own stock to pay for stocks, but in essence you might, because you might be selling a good position you have that's running well in order to buy a stinker.
It's not even that he sold an okay stock. He sold the best stock.
Yeah.
Right? He wasn't even he literally gave up the best position. I think one of the things that I take away most of it is the recency bias that he mentions, and he doesn't call it that, right? It's like I said earlier in the video, we bought in shoe companies and they did well. Therefore, we're going to keep
buying shoe
companies. And we trusted this manager and he's done well in the past. Therefore, he will do well again. And it is an indicator that he might, but it's not a for sure thing.
Well, I would say you can be pretty confident that's the case. In his 1993 share letter, he said, in quotes, he said, "I come to work every day saying there's no business like the shoe business."
Right. Exactly. So he
definitely had a bias.
Right. There was recency bias because of the past, but with that quote, there's also confirmation bias. There was nothing you could tell him at that time, I don't think, because of that quote, that you would have persuaded him otherwise. And so you have to be very cognizant of that. And even Buffett got caught up in his own psychological biases. We're all prone to them. We're all going to have them. We can't get rid of them.
For sure.
So the only thing that we can do is be aware that we have them.
Yeah.
And then work with
deal with them as best you can.
Right,
Yeah.
exactly. So that was one. So the recency bias and the psychological biases we have, that was huge for Buffett.
Mm-hmm.
And then also just not to be discouraged, because if he makes mistakes, we're surely going to make them.
Absolutely. There's no question.
Right? The question is admitting them and moving on. And I think Kevin O'Leary says, okay, you just have to mourn the $433 million cash and the whatever $1 billion Berkshire stock, and then press forward.
And then move on.
And then press forward.
Right.
Yeah. So I think to end this video today of Warren Buffett's self-proclaimed worst investment that he ever made, I'll end with a quote.
Yep.
And he says, I gave away 1.6% of a wonderful business, one now valued at $220 billion, to buy a worthless business. And that's from the 2007 shareholders letter.
Yeah.
So I'm sure he thinks about that quite often, because he's brought it up in several different
shareholders letters.
Yeah, and annual meetings and whatnot. So that wraps up our discussion on Buffett's worst investment. If you could like and subscribe this video, that would be helpful. And we will see you next week.